The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone, and welcome to the June webinar titled Roadmap Toward Retirement, courtesy of Principal Financial Group. We appreciate all of you taking the time to join us today. This webinar is part of our ongoing monthly webinar series, and today we will be taking a look at how you can determine if you are saving enough for retirement, the basics of investing and investment options available in the retirement plan, and how to stay on track to meet your goals. A few housekeeping items before we get started. First, please note that in order to ensure everyone has the ability to hear the information presented by our guest speaker, everyone will be on mute during the webinar. During the presentation, feel free to write in any questions you have using the Q&A link on the webinar menu. Then, at the end of the presentation, we will take time to go through these. With that said, I'd like to introduce our guest speaker, Jose-Luis Montiel, Senior Employee Benefits Specialist at Principal. Jose-Luis is part of the Education Services team at Principal, and in this role helps educate plan participants on issues such as investment option choices, diversification, and retirement planning. I would like to thank Jose-Luis for joining us today, and with that said, Jose-Luis, I'll now turn it over to you.
All right, thank you so much. Again, my name is Jose-Luis Montiel. I work with Principal Financial, and again, I title that presentation Roadmap Towards Retirement, really about setting a course for ourselves and making sure we take advantage of all the resources out there to put us in the best position for long-term success. Ultimately, we're going to be covering quite a bit of information here today for you, and that first conversation of determining if we're saving enough is probably the most important one. Your contribution is always going to be your number one factor in success, and it's very important that we take quite seriously what we're contributing towards the plan and what we should be contributing over time. Bottom line is that every contribution matters, and whatever you can afford to contribute towards the plan is going to make a difference, but we also have to be realistic, and if I'm somebody that's contributing 4 or 5% of my check today, that might not be enough to ultimately get me to where I need to be long term. So we're going to talk about that. I also want to review investment choice and the importance of reviewing your individual investment choices on an annual basis, not necessarily changing those investment choices so regularly, making sure that I know what I have and what's ultimately available to me. That last point there as far as staying on track, well, I can't really stay on track until I set a goal for myself. And that's really the takeaway I'd have you get from today, is making sure that we take advantage of resources, calculators, that are going to give us a clearer idea of what we should be working towards over time. Again, determining if we're saving enough is going to be a very specific question to our personal situations, but what most analysts will tell you is that you generally want to be saving somewhere close to about 15% of your total income, including any type of employer match, to get to where you want to be long term. And to get to where we want to be, I think we'd all agree that our retirement goal should be to maintain our same standard of living, if not to improve that standard of living. Keeping in mind that average retirements are running over 20 years these days, replacing 80 to 85% of our income is going to be quite a bit of a goal. We need to make sure to take that quite seriously. And one of the ways to make sure we maximize our plans are making sure we understand exactly how those plans work. And each one of our providers is going to offer us different types of plan provision information or plan summaries. And it's important we review that we understand what we have available to us, and try to make sure that we review annually what my contribution limits might be, when I can make contribution changes, ultimately how my plan works and how I can take best advantage of that. Lots of different tools out there, whether it's simply running a retirement savings worksheet or running a calculator, but I'll say again that you need to set a goal for yourselves. I think it's pretty logical that if we were going on a road trip that we'd have an address of our destination. We would have a GPS or a map to get us where we needed to go. We need to think the same way about retirement, that if I don't have a goal set in mind, well, I'm not necessarily driving towards that goal as clearly as I should be. And if I don't have that worksheet or that calculator out there that I'm taking advantage of, well, I'm not using that GPS, I'm not using that map to get me to where I need to go. Lots of tools out there for you, but again, we make sure that, we encourage you to make sure that you take advantage of a resource out there to get some clarification for yourselves. I really can't discourage any contribution, and whatever you're able to contribute matters. But again, we have to be realistic with ourselves and talk about what we're ultimately working towards. Again, average retirements for individuals retiring at 65 today are running about 24 years. Replacing 80 to 85% of your income for potentially 20 to 30 years in retirement is a lot of money, and I can't shortchange that for you. We have to be quite honest with ourselves and confront that situation, make sure we're saving towards a retirement plan and we're working towards those goals as well. It's pretty unrealistic for me to assume that you can just save 15% or more of your income on a regular basis. You have to start somewhere and work towards that goal. It's the incremental changes over time that are really going to have big impacts for you. Keep in mind that traditional contributions towards these retirement plans are done so on that pre-tax basis, the idea being that a traditional contribution is going to reduce my taxable income, that contribution is coming out of my gross income, so there's more working on my behalf than the difference in my take-home pay. What I mean specifically is if I look at this example of somebody making around that $1,300 every pay period, they're not contributing towards their plan. Of course, they're paying full income tax on what they earn. The person making an 8% contribution in this example of $108, well, they lower their taxable income. They see a tax savings that check of $27, but over the course of the year they see that tax savings of over $700. If I look specifically at that tax savings of $27, what we mean is that that $108 contribution only reduced pay by $81. So again, with our pre-tax or traditional contributions, there's more going towards the account than the difference in our take-home pay. The idea behind that is that we're deferring tax on contribution, we're deferring tax on earnings. Come retirement, we're going to pay tax as ordinary income on our distributions that we pull out in retirement. Again, the idea is making sure that we choose the level of contribution we're comfortable sticking at and understanding with those pre-tax savings what we're doing is lowering our overall taxable income or the amount the government can charge us in tax that year. So sticking with that comment I made a second ago, that impact on your take-home pay is generally less than the amount you're contributing towards the plan. So we have on the screen here a couple of different examples of salaries and contribution rates and what those differences might be on that individual's take-home pay. Again, keep in mind that difference is less than the amount you're contributing towards your plans. Regardless of the amount that you choose to be contributing, get it in there as soon as you can. The truth is we can't procrastinate when it comes to retirement savings. We need to take advantage of compound earnings over time, and the idea that our contribution, along with any interest gain reinvested for us over time, has a lot of power behind it. Time is absolutely a factor when it comes to retirement planning, and quite simply, time is money. The more time I have towards my date of retirement, potentially the less I need to contribute towards my date. Ultimately, that person that delays, that person that waits, well, they don't have as much time to be contributing, so they need to contribute quite a bit more. Compound earnings is a huge benefit for you, and I think one that a lot of us are familiar with that have been saving in retirement plans for a while. Those of us maybe having a little less experience, well, compound earnings I think is pretty easy to understand if we think about that. In a cartoon we've all seen where a snowball is on the top of the mountain and it rolls down to a big boulder. Well, that's a lot about the idea behind retirement planning or compound earnings, the idea that the younger I am, the higher up on that mountain I am. And the more momentum my contribution is going to have behind it. Just like that snowball that built up some steam and ended up building into that big boulder, well, our contributions, again, the more time we have behind them, have a lot of time to grow on top of themselves. So the sooner I start with my savings, the more impactful they're going to be for me over time. And realistically, 9 times out of 10, $20 with 30 years to grow is going to be stronger than $100 with 10 years to grow. The sooner I get that money towards my account, again, the better off I'm going to be and the more impact that contribution is going to have behind it. Small incremental changes really have big impacts, though, and again, we can't stress that enough. The example I'm showing here of Elaine and Philip, 2 individuals that decide to start saving at an 8% level, and what their accounts look like over 25 years. Philip having decided to do an 8% contribution each year and never changing it. Elaine deciding, well, she was going to start at that 8%, but she was going to bump it up 1% each year for the first 5 years she was involved, stick at that higher number, and maintain that for the following 20 years. Philip's situation here, he's able to save almost $110,000, and he sees an account balance growth of over $250,000, which is great. But Elaine's situation of having started and bumping it up that 1% each year, she saw some incremental changes, and that change of just 1% in this example ended up being just about $10 a week for her. That $10 a week each year for that first couple of years, maintaining that higher number, she's able to save almost an additional $65,000. That additional $65,000 meant more than $140,000 for her in retirement. Again, small changes have big impacts, and they're easier for us to swallow over time. Again, making a change of $10 or $20 a check might not break our banks, but it's going to make a huge impact on our long-term retirement savings. Sticking with that example of Elaine and Philip, we're going to use this example of someone making around that $35,000 a year, and the reason we use that is because each percentage point ends up being about a difference of about $10 in take-home pay. If we look at this chart here, the difference in percentage numbers, certainly over those 20 and 30-year time frames, are quite impactful, but even over a 10-year time frame, a difference of about $10 or $20 a check is a big difference for us. If I'm looking simply at that first column of somebody contributing 4% of their check, if they're to bump that up to 5 or 6%, over a 10-year time frame, they can see a difference of about $5,000 to $10,000 in those changes of 1 or 2%. Over that 20 and 30 years, certainly those numbers are going to multiply for us. Again, the more I contribute towards the plan, the better off I'm going to be. We can't say enough that if you're not saving for yourself, no one's going to do this for you. No one's going to force you to increase the contribution amount. You have to have that responsibility of looking long-term of where you want to be. And also being realistic that not everyone's going to be perfect at all times. What's important is that I contribute every pay period, that I have that goal set in place, and that I know what I should be working towards over time, that I do my best to try to get there. The truth is all of our situations are different. And I think we all know that budgets could potentially help us get to where we're going as far as getting a clearer picture of where our income and expenses lie each month. Maybe not all of us are living off of defined budgets, but we all have those undefined budgets. We know how much we're spending on our bills on a monthly basis. We need to make sure and get an idea of what those smaller expenses are that are eating up our accounts that could potentially help us get into better positions and able to save that extra $10 or $20 a check. Some ideas, though, just to better our personal situations, of course, are trying to pay off high interest debt as soon as I can. If I'm in a position to do so, I always want to focus on that higher interest debt to make sure that real cost of my debt isn't extended for me. If I'm in a position to pay cash or avoid new debts, obviously that's going to help me as well. What's nice for a lot of us is a lot of our banks offer those online statements these days, and it's pretty easy for us to get an idea of where our expenses have lied over the past couple months. Like I said, I think we all have those undefined budgets. We know what we are spending monthly on our housing or on our insurance or electric bills. It's those other payments that tend to eat up our accounts and maybe could be affected quite a bit by some small changes. I can't stress enough, though, that the amount you're contributing is absolutely the number one factor in your success. And we really need to take that very seriously when considering how much I'm putting down towards my retirement. The amount that I contribute is that number one factor, and investments will make a difference. But the truth is the amount you're saving is always going to be that number one leading factor for us, in the sense that that person that's saving 12, 13% of their check and they're invested conservatively, well, they're going to outperform that person that's saving 7 or 8% of their money and they're investing that very aggressively. You want to make sure to take that quite seriously and make sure that you're trying to bump up contributions over time. As far as investment choice, like I said, we need to make sure to review that on an annual basis. Make sure we know what we have invested in, what we have available to us, and that we make appropriate decisions for ourselves. What's consistent about investment markets is that they tend to follow the same patterns over and over again. We tend to see cyclical patterns in our markets. Those cycles continue over time, and we need to make sure that we follow fundamentals of investing to get us in the best position for long-term success. Some of those fundamentals being diversifying portfolios and spreading risk over many asset classes if we're in positions to do so. What we mean is that it doesn't make a lot of sense for me to be heavily invested in any one direction, whether that's aggressive or conservative. A person that is heavily invested in one direction generally sees more volatility than a person that is spreading that risk over many vehicles. Rebalancing of your portfolios is something we encourage on an annual basis. If you are a person that is investing in individual separate accounts or mutual funds, it's important for us to rebalance ourselves on an annual basis. If we're taking advantage of those more hands-off, target-dated or risk-based portfolios for us, those accounts are generally rebalanced automatically for us, and that's one of those benefits of those more hands-off approaches. I also need to keep in mind that there's risk associated with really any type of investment vehicle. The investment risk is that most common risk of volatility in our markets over time, but inflation risk is a very real one as well. If I'm that person that maybe isn't so comfortable taking on a high level of investment risk, well, that's perfectly fine, but I need to keep in mind that on those more conservative vehicles, I need to make sure at the very least to outpace inflation. If I'm in that safest cash or stable value type vehicle, I'm generally not going to see any type of investment risk or downside risk, but I'm not going to see any investment potential either. And cost of goods in our country generally goes up about 2 to 3% a year. If my money's not growing at that same rate, well, I might not be losing dollars and cents, but I'm losing the value of that dollar. It's important I keep that in mind when building a portfolio for myself, that I want to have an asset allocation or diversification over available asset class that both weighs investment and inflation risk, but ultimately satisfies my goal of whether that's that long-term aggressive growth or short-term more conservative protection of my assets or whatever it might be. I need to make sure my asset allocation reflects what my needs and my ultimate wants are for my investment vehicles. Keeping in mind that volatility is a very real thing. Our markets fluctuate quite a bit. Longer holding periods, our market shows very positive returns, but on short periods of time, our markets can be very inconsistent. We've certainly seen that over the past decade or two. This example we show on the screen here is 20 years invested in the S&P 500, or I should say a $10,000 investment in the S&P over 20 years. So from 1994 to the first 15 days of this year, if I was invested for every single day in that time period in the S&P, my $10,000 investment would have grown to just under $40,000, or saw a return of about 7%. If I was to miss the best 10 days of returns in that 20-year time frame, that potential $40,000 is now worth just a little bit less than $21,000. Missing the best 20 days of returns, that potential $40,000 is now under $13,000. Missing those best 30 days, that potential $10,000 is now worth less than $8,500. So what's that mean to me? The 20 or 30 days in a 20-year time frame are going to determine your return. I think we all know that nobody has a crystal ball to tell you exactly when those days are going to take place. Our markets are cyclical. They follow the same patterns, in the sense that we generally see about 5 to 6 years of growth, followed by about 6 to 12 months of declines. We see that pattern continue over time. When markets go down, I shouldn't assume that they're going to continue to go down forever and that they're never going to recover or show returns on top of that. That's just not what history tells me. Unfortunately, individual investors tend to overreact, and when we see markets move, we generally make short-term decisions that have long-term impacts for us. The timing of the market is going to hurt more than it's going to help you over time. A lot of times people move investment vehicles assuming that they're going to know when to move in and out of markets, and the truth is we don't. If I'm a person with 15 or more years to my date of retirement, just because markets are fluctuating or going down doesn't mean I should change my investment allocations. If I'm a person getting closer to my date of retirement, I want to have somewhat of an exit strategy in the sense that I want to be moving more conservatively the closer I get to that date of retirement. Not necessarily moving assets when markets are down, but when markets are at their top, similar to where we are today, we want to make sure and make those decisions as far as, am I somebody that maybe wants to start moving more conservatively? Because short time frames, again, can be very inconsistent. The long trends are very positive, and that's why it's so important for us to choose allocations we're willing to stick with over time and allow our markets to move and give us that positive potential for growth over time. We want to be honest with ourselves about how hands-on or hands-off do we want to be with our investment management. We're somebody looking for a faster, easier way to get started, maybe a preset model, whether that's on a risk basis or simply according to our age and expected date of retirement, or I'm somebody that wants to build my own portfolio and wants to be very hands-on with my management. Principle, we tend to categorize investors into two categories, or a do-it-for-me or do-it-myself type investor. A do-it-for-me individual being somebody that wants to be a little more hands-off, that they want more of an autopilot feature set for them, whether, again, it's risk-based or based by their age and expected date of retirement. Maybe they don't feel as comfortable with investment concepts or simply don't feel that they are in a position to be able to build their appropriate asset allocation without some help. A do-it-myself individual has a strategy in mind. Whether that's conservative or aggressive, they want to be more hands-on with building a portfolio, taking those individual investment decisions, and monitoring these accounts over time. Certainly I can show characteristics of both, but it's very important that I'm honest with myself and understand that in most cases my plan is going to offer me solutions for both, whether or not I want to be hands-on or hands-off. What's important is that we keep that long-term focus, that we choose allocations, again, that are properly diversified, that we're going to be comfortable sticking with for longer holding periods. So once we've decided, again, how much we want to contribute, how we want to invest those dollars, that next step is running through some sort of resource to get a goal for ourselves and so we can stay on track for that goal over time. We have to be very realistic about the fact that if we're not saving for ourselves, then no one is doing this for us. We have to pay ourselves first. What we're doing today is saving to be able to pay ourselves come retirement. We have so many obligations on an annual basis, I should say on a monthly basis, that sometimes we overlook those small changes that can have big impacts on our future. It's important that we revisit our contributions and investment elections, again, at least on an annual basis, to make sure I remember how much I'm contributing, how I'm investing those contributions, and that I revisit some type of a calculator and take a look at where I should be over time. You know, if I was to change nothing, what would my account look like in retirement? What should I be on track for? And if there's a gap, what should I consider doing in the next 12 months or so to get myself in a better position for success? Make sure that you have beneficiaries set for yourselves. Those of you who've been in retirement plans for a little while, make sure you update beneficiaries if you had some life changes. You should be getting statements on a regular basis. Make sure you're reading those statements, that you know what your balance and contribution amounts are and how those have impacted your retirement success over time. We focused on those pre-tax or traditional contributions towards the plan towards the beginning of the presentation, but you might be in a situation where your plan offers a Roth elective deferral as well. A Roth elective deferral is going to be handled differently than that traditional contribution in the sense that with a Roth deferral, you're contributing after tax. So there's a little less working on your behalf. But the idea behind that is that come retirement, I would pay no additional tax if I met the requirements of my account being active for at least 5 years for my first Roth contribution and being at least 59.5 years of age come retirement. In a Roth scenario, my earnings in essence are tax-free to me. So if I went back to that earlier example of that individual that was making that 8% contribution on a pre-tax basis, if you remember that was at $108, we remember it said it was lowering our taxable income. We saw a tax savings of $27. Again, that $108 reduced our pay by only $81. Well, if I was considering making an 8% contribution on a Roth basis in that example, that 8% would have been $81 as opposed to that $108 on a pre-tax basis. With the pre-tax scenario, again, there's more working for us, but we're going to pay tax on contribution as well as earnings come retirement. On a Roth basis, we lock in our taxes today. We don't pay any additional tax on those earnings on our accounts if our accounts, again, meet those requirements of being at least 59.5 years of age and being, again, having that account active for at least 5 years from that first Roth contribution. So generally, I might be a good candidate for a Roth deferral contribution if I'm somebody that is not able to participate in a Roth IRA because of income requirements, someone that's already established quite a bit of savings, maybe somebody that believes I'll be at a higher tax bracket come retirement. Well, in that case, or maybe if I simply feel that tax rates will go up quite a bit from now until my date of retirement, well, that Roth would be attractive to me because I'd be able to lock in my taxes today, again, not have to worry about that taxable liability on the way out come retirement, as opposed to maybe somebody that hasn't started saving yet or hasn't built quite a bit of savings. They might want to consider that pre-tax contribution, again, because there's more working on their behalf. Maybe they feel that they won't be at a higher tax bracket come retirement, and in that case, again, that pre-tax might be more attractive for you. The important thing, again, is making sure that we review our plan summaries, review those plan provisions on our accounts to make sure we understand what those deferral options are available to us, whether or not we have that Roth option available. If you are somebody with an old retirement plan from a previous provider, or I should say previous employer, whether that's an old 401k or an old IRA, consider consolidating those accounts within your own plans. These plans are designed to be portable. We always encourage you to move them with you the closer you, when you are to change jobs, so that when you do get closer to your date of retirement, you only have to deal with one provider. That simplicity factor is a big one, but also simply keeping assets with our employers generally seems a lower cost for us as well. Very few scenarios where I'm going to encourage you to maintain separate accounts, or I should say various portfolios. And most times you're going to be mirroring those investment strategies, and if that is the case, it makes more sense to combine them. If I am somebody that has an old 401k or old IRA in that investment lineup, there's some options that aren't available in my new lineup, and I'm a very big fan of those options. Well, maybe that's the reason to keep that old account, but if I'm following the same investment strategies, it's always better to consolidate them, and again, the cost is generally in my best interest as well. Keep in mind that when we do consolidate balances, again, we're going to be able to deal with that one provider come retirement as opposed to many others, and again, we can avoid being affected by any changes in our former employer's plan as well. So again, keeping that stuff in line with our current allocations, making sure everything is moving according to the same goal. Changing the conversation a little bit, we want to move into a little bit of an update on the economy. And to understand the economy, we first have to understand the role of the Federal Reserve, or commonly known as the Fed. Congress created the Fed in 1913 because the U.S. lacked any formal organization for studying and implementing monetary policy. Markets were often unstable, giving the public little faith in the banking system. Excuse me. Overall, the Fed's mission is to foster a sound banking system and a healthy economy. To accomplish this mission, the Fed serves as the banker's bank, the government's bank, a regulator of financial institutions, and the nation's money manager. Its decisions don't have to be approved by anyone in the government, but Congress periodically reviews the Fed's activities. It's the banker's bank because each of the 12 regional Federal Reserve banks located across the country provide services to financial institutions the same way regular banks provide services to individuals. This helps ensure the safety and efficiency of the nation's payment system. It also serves as the government's bank. The Fed's biggest customer is the U.S. government. Similar to how you have a checking account at your local bank, the U.S. Treasury has a checking account with the Fed. All revenue generated by taxes and all outgoing government payments are handled through this account. The Fed sells and redeems government securities like savings bonds, treasury bills, notes, and bonds. It also issues all our currency, takes damaged currency out of circulation as well. The Fed acts as a regulator and supervisor because the Federal Reserve Board has regulatory and supervisory responsibilities over banks, including monitoring member banks, the international banking facilities in the U.S., foreign activities of member banks, and the U.S. activities of foreign-owned banks. The Fed also develops federal laws governing consumer credit to help ensure banks act in the public's best interest. In short, it polices the banking activities in the U.S. and abroad. The Federal Reserve Board also sets margin requirements for investors to limit the amount of money an investor can borrow to purchase securities. That current requirement is 50%, meaning you can buy up to $1,000 worth of security with $500. Keep in mind, of course, margin accounts are not available within retirement plans. Last but surely not least, the Fed acts as a money manager. The primary responsibility of the Fed is creating and implementing monetary policy. The term monetary policy refers to the actions undertaken by a central bank, such as the Federal Reserve, to influence the availability and the cost of money and credit to help promote national economic goals. Changes in the federal funds rate trigger a chain of events that affect our short-term interest rates, foreign exchange rates, long-term interest rates, the amount of money and credit, and ultimately a range of economic variables, including employment output and prices of goods and services. So in short, the Federal Reserve's decisions have a direct impact on the overall economy. So in the first quarter of this year, the Fed took action to maintain low rates on Fed funds in an attempt to continue to ease market liquidity. Let's take a look at some tailwinds and headwinds in the first quarter of this year. So first, those tailwinds. Employment's improving. While the March employment report may have disappointed those expecting a spectacular surge in non-farm payrolls, the overall tone of the report, nevertheless, was very solid and suggested that negative winter effects are steadily being unwound. The sharp drop in the number of long-term unemployed is very encouraging. Capital spending also prepares to ramp up. Despite strong corporate cash flows, low levels of leverage, and historically cheap capital, companies have maintained low levels of capital expenditure since the financial crisis. We believe this may be about to change. Commercial and industrial loans have started to surge at the fastest pace of expansion as capital spending prepares to ramp up. Also, housing recovery continues. Plans to buy houses are back to average levels, and the number of residential foreclosures fell back to the 2005 and 2006 levels. Not to mention, state budgets are in better shape. State coincidence indicators are healthy, and tax revenue is surging. Let's spend some time on those headwinds as well, though. Legislative and Fed action impact. Uncertainty regarding those potential legislative policy continues to impact business and consumers. In addition, there could be market disruptions and slower growth as investors begin to anticipate the Fed's initial steps to remove its extraordinary policy accommodation next year. Further, the Fed's new approach to forward guidance is subject to a much wider range of interpretation. Another thing to consider is geopolitical turmoil. Yields on U.S. Treasuries and other safe haven bonds are likely being pressured by geopolitical risk around Russia's annexation of Crimea. Investors can't really discern Russia's ultimate intentions for Ukraine or adjacent regions of Eastern Europe, so the push into safer sovereign bonds is holding down yields. Trade deficit's also a factor, and unlike fourth quarter of 2013 where trade was accretive, it's likely a drag on real GDP in the first quarter of 2014. We also want to consider structural headwinds in China. The long boom led to imbalances in financial stress that are creating structural headwinds to growth today. So what does all this mean to us? Well, we need to stick to our fundamentals of investing. And again, one of those main fundamentals is considering a diversified portfolio. What we see on the screen here are the best and worst returns in our market over individual asset class size and style from 1999 to the end of 2013. There's very little consistency on this page here, and if you can find more than one pattern, we're going to be more than happy to hire you a principal. The truth is that the way our markets move, that they tend to fluctuate quite a bit. What's on the top tends to go to the bottom. What's on the bottom tends to go to the top. If there is one consistency, it's that diversified portfolios generally see the smoothest growth patterns over time. If I was to follow just one asset class, REITs or real estate investment trusts, I would have seen quite a bit of volatility. And 1 year on the very bottom of the market, 1 year on the very top. If I look at different asset classes, small growth stocks follow a pretty similar pattern as well. The truth is the people that see this type of fluctuation in their accounts tend to make a lot of movements in their accounts and tend to try to time markets quite a bit and move in and out of different vehicles more than that person that is properly diversified and tends to see a smoother growth pattern over time. The bottom line is that nobody has that crystal ball to tell you exactly where markets are going to move. But what we know is that over longer holding periods, our market shows very positive returns. And a gentleman won the Nobel Prize in economics quite a while back now for proving that an investment held for at least 10 years, less than 10% of your individual performance had to do with actual stock selection or timing of the market, that more than 90% of your performance is directly related to asset allocation. But the truth was it wasn't about timing of the market or individual stock selection. It was about time in the market, covering all of the stock selection. That if the market was showing positive growth, that I was also participating in that positive growth. That individuals who were heavily invested in any one direction saw the most volatility and in turn made the most investment decisions that ultimately hurt them more than helping. That those people that were consistent and stuck to their investment strategies generally saw smoother growth patterns and generally participated in more growth over time. Again, the truth is that volatility is a very real thing. And our markets have gone up for just about 5 years since our market was at its previous bottom. We should anticipate that markets will go down again in the near future. We should also anticipate that markets will recover after that and show positive returns on top of it. By having a properly diversified portfolio, I'm not going to have to worry about changing my allocations when markets go down. I'm going to be able to stick to my guns, let markets recover, and see positive growth on top of that. Again, the truth is there are a lot of factors over time that could potentially sway us and make us think that we should be changing investment vehicles, when the truth is we need to look, again, to our comfort levels. We need to look historically and build an appropriate allocation for ourselves. It's going to put us in that best position for long-term success. I know we covered quite a bit of information here today, and I want you to know that I certainly appreciate your time in joining us today. Pensionmark's going to have a lot of ways for you to reach out to them and contact them over time if you do want additional information. The truth is we want to make sure to take advantage of all the resources out there, and any tools available to us are always going to put us in a better position for success. Any questions on anything we covered today as far as contributions, investment vehicles, that quick review we did on the market?
Thank you, Jose-Luis. That was all very insightful information. And now we have some time to answer any questions. Please remember that if you have any questions, you can submit them using the Q&A tool on the webinar menu. As always, for any plan-specific questions, you can always reach out to your dedicated service team here at Pensionmark. As we wait for questions to filter in, I would like to take a minute to let everyone know that you can stay up to date on the latest retirement plan news and events via Pensionmark's Facebook, Twitter, LinkedIn, and YouTube pages. Links to our social media sites can be found on our website at www.pensionmark.com. In addition, this webinar is recorded and the replay will be posted on our website on the Investor Education Center as well as our YouTube page within 10 business days. And so we still currently do not have any questions. So Jose-Luis, thank you so much for your time. And that will conclude our period for questions and answers. If anyone has any additional questions, please feel free to reach out to your dedicated service team here at Pensionmark at 888-201-5488 or at info@pensionmark.com. I thank you all for joining us today, and once again, Jose-Luis, I would like to thank you for taking the time to present.
Thanks so much.
This now concludes the webinar. Thank you.